afternoon to everyone who has joined us today at the Singapore FinTech Festival. My name is Hari Rajmohan, and I am an investor with SC Ventures out here in Singapore, and I'll be a host today. We have an amazing set of panelists joining us from around the world. First up, we have Mike Sigal from Upside Partners. Mike is a veteran VC and was previously a partner at 500 startups. We have Anant Bhardwaj, who is the founder and CEO of Instabase, a technology startup based in California. Instabase is a platform that helps large organizations understand complex documents for a bunch of use cases. More details to come shortly. Both Mike and Anant are joining us from San Francisco. And joining from the UK, we have Lucy Demery, who heads up fintech banking for Standard Chartered. And from here at home in Singapore, we have Alex Manson from SC Ventures, the innovation and venture arm of Standard Chartered. Now, the panelists may appear to be from different parts of the fintech ecosystem, and for most part they are, but they surely are not strangers to each other. Both Mike and Alex are members of the investment committee of the Standard Chartered Ventures Investment Fund. And Instabase is one of our very first investments. And Anant and Instabase have a long history with Standard Chartered. We'll get into a little more detail later in this conversation. And Lucian and her team is responsible for the fintech sector as a client segment for Standard Chartered. And as Instabase scales, they are fast becoming the next hot prospect for her team. So I welcome you all to this discussion for the next 40 odd minutes. The first question is for you, Alex. SC Ventures has been around for more than 2 years now. Some of our friends in the industry have noted that our strategy is similar, but yet different to some of the other innovation arms that we see around. So, give us a little more color on how it all started. What was the rationale? What was the mandate, and the whole story behind it?
Sure. And hi everyone. Thanks for joining us. The SC Ventures is, I think, a little different in terms of the setup, if not the individual activities that we conduct. So we amalgamate an innovation lab, which we call the accelerator. We deploy capital in the partners we work with, and that's the investment activity Hari just referred to, to explore alternative business models outside of the bank. And the combination of these three things is what we call SC Ventures. Couple of major differences. One, first, we only invest in partners we work with. So we have worked with Instabase for a long time. In fact, we design use cases together in collaborating with them very, very closely long before we thought of deploying an investment. And this is a mindset to invest, which is, I think, a little different from certain VCs and also most CVCs, in that it's not good enough for Hari, myself, to think an idea is a good idea. We really want to get close and once that idea is implemented in the bank, it's interesting, but just that, unless we help our partners scale. And because in order to help us change our bank, let alone banking, they need to scale. And meaning we at this point want to help them scale. And there's a very big commitment on our part to do this, which we kind of justify in the same time as we invest in our partners. And in the same time, when we tell the founder, this is what we really think would be good, or you should do that now, there's also a sense that we're in this together and that we've aligned incentives. So that's one first difference. The second difference, I would say, is that the premise we started with is that a lab on its own doesn't work, does not achieve transformation of any corporate. Even the best labs failed to achieve that kind of transformation for the corporates that they were sponsored by. The second premise is just investing in fintechs wouldn't work either. In fact, these operations typically disappoint their backers, either because they're so close to the bank that it becomes very strategic but also very clunky and unwieldy and very bank-like, or therefore you get adversely selected, and the likes of Mike Sigal sort of swear that they'll never deal with a strategic investor again because they're difficult to deal with and give you lots of surprises as you execute deals. So there's an element of adverse selection that comes in. Or they're so well set up outside of the corporates, far away, that you wonder what the corporate gets out of it. And it's not actually diverse real innovation dollars that could be used for POCs and working with the likes of Instabase instead. And then the third thing is ventures also take too long. They're too small, take too long to materialize, to really move the needle in transformation. So in other words, 1, 2, and 3 don't work, which begs the question, why bother? And the bet we really have made at SC Ventures is that the combination of these three things is a very powerful thing. That the virtuous cycles that happen across the different activities, the flow of people, individuals, best practices, ideas, indeed capital, has a huge amount of transformational power, which is what we want to use to rewire the DNA in banking.
Thank you, Alex. Very helpful background. Do you want to tell us a little more about some of the portfolio companies that came, that we're close to over the last, say, 12 to 24 months, that we looked at our relationship and some of the, I guess, investments that you want to talk about?
I think I'll keep it relatively generic in the sense that our portfolio is quite public for the most part, and this is, people can look it up. But I would say every single one of these portfolio companies is a capability that we thought was extremely attractive, that the bank was supposed to have, and that it made a lot of sense to bring from outside, as opposed to try and do it yourself or try and they were capabilities that we wanted to bring into the bank, or at times some of our ventures. We stumbled on the activity. Some time ago, our first investment was in a company called Ripple, which some of us did almost on the side of the desk before the fund was even set up, and obviously that company has gone from strength to strength. In the same time as they were partners of ours. But this is, this is how we reflected on the mindset in which we're investing, which is the working together and the implementation of a technology, and therefore the deeper understanding of not only the use case, but also how the use case gets solved and how things happen down the line is what got us thinking that, that there really was a business model we could apply. Every one of these is different. I'd say, initially we focused a lot on obviously payments, but also data analytics, data preparation, AI, machine learning, obviously. And then we evolved over time into new themes, which I think we should leave a bit of time to speak about, because the themes that we are now focusing on are a little different from what they were at the beginning, and now post pandemic, where people are working remotely, and digital habits have evolved. So we're very focused on infrastructure, on cybersecurity, on the infrastructure of the future, generally speaking. Ranging from safety to digital assets and the likes. So an evolution of the themes as well.
Mm-hmm. Right, and picking up from what you said, a stellar capability and working together. That brings me to Anant. So Anant, tell us your story, the Instabase story, where it all started, and in your journey, what was your experience working alongside Standard Chartered?
Yeah, thank you for the invite. It's great to be here. So I'll basically split my answers in two parts. One is the sort of Instabase story, and the second one is when we started working with SCB and our experience. So before Instabase, I was a PhD student at MIT, and we were working on this project called Data Hub, which was sort of this vague idea of how you can build a platform that can act as a central hub for running applications on top of any data. So that was kind of the very vague idea. And I dropped out in 2015 without knowing where it would be useful to come to Silicon Valley and San Francisco in particular. And the first 2 years or so, we literally had no idea what kind of applications we'll build. We basically focused primarily on the operating system aspects and the distributed platform aspect. And at that time, like SCB was visiting Silicon Valley, and we were 4-people company. And literally we had 4 people, and we had like one lending fintech company as our customer where they were trying some use cases. So we met Michael Gorage and Shamik, who were visiting some VC funds in the Bay Area, and they saw the demo, and they invited us to come to Singapore. And at that time, there was, I think SC Venture had not started. There was something called SC Studios, and maybe that was the precursor of SC Ventures. So we got invited into SC Studios, where sort of like we met Wei Ming, and they invited me for a week, where over a week they called like 50 different teams to see how whatever we are building can be applicable to them, and how sort of like there could be value from both sides. And I don't know if Wei Ming is the audience. He literally sat with us in all those 50 meetings over like 7 days to really nail down like few key use cases that can help prove Instabase capabilities. And then over the next 3 months, sort of like we worked on sort of those use cases, and so that we can go and really showcase that whether it works or not works and so on. But sort of like, especially with a company of like kind of 4 people, as you know, like navigating an organization like Standard Chartered is not easy. It's very, very hard. Navigating a large enterprise is very, very hard. And it just would not have been possible if like SC Studio didn't exist, and there is no way we could have done this. Over the next 3 months, of course, we basically built the basic prototype for those use cases, and that helped us get into more serious discussion. And then SC Studios helped us sort of like navigate with the sort of the sales cycle, procurement, and the whole deal and everything. So if I have to summarize, this is like SCB gave us a really like fail-safe environment to experiment and learn. And some of these things for the first time founder, it's very, very hard. We didn't have any sales team. We didn't have sales engineers or account executives. We were just like 4 engineers. That's the whole company was. And we came here, and there is just no way to learn it without experiencing. So there's no template or reading can help with that. So it was all about getting the right experience. And I think SCB sort of like helped us navigate all those, and they became one of our first customers. And whatever we learned over the next like 9 to 12 months, those became the foundational use cases for most of our next set of customers. So like our customers are mainly large banks across the globe, like Goldman Sachs, Bank of America, Capital One, Royal Bank of Canada, and so on. And many of the use cases that we served to those places came from the learnings that we had Standard Chartered. So it is more like partnership where we work together to understand. And along the way, we made a ton of mistakes. It's not that everything went like we deployed Instabase and everything worked. There were errors, there were bugs, but the kind of help that sort of like we got it's literally like a fail-safe environment where you can go and make some mistakes, and we'll work together to fix it. So hopefully that summarizes both, which is how we started Instabase and the experience with SCB. But these are not mutually exclusive. I think SCB played an important role in defining what Instabase today is.
That's very kind, Anant. I can just confirm that Wei Ming is definitely in the audience. He wouldn't miss you for the world. Sitting not very far away from the desk I'm at right now.
Okay.
Thanks for your kind words.
That's exactly right. A special shout out to Wei Ming as well. Turning to you, Mike, you have been in this space for a very long time. So just curious to hear your thoughts on our SC Ventures' operating model. How is SC Ventures different from a typical venture capital fund? So Alex spoke about some of the other CVCs and the innovation arms of banks, but specifically on other VCs, where do you see the distinction?
Well, I think it's probably important to start off by talking about what makes it like a VC fund and less like a corporate VC, because that's one of the things that I think is distinctive. In that, our thesis says invest in capabilities at usually Series B or later that are going to be useful for financial services enterprises and potentially other enterprises. Once we're past that filter and that a company has worked with the bank, then in our investment committee criteria, we're operating exactly like a VC. We want to invest in companies that are going to be global dominators, that are going to be unicorns, right? We want to provide them partnership to help them get there. One thing that makes us very different from most CVCs is we don't really have to concern ourselves then with, are we investing alongside someone who in banking land would be a competitor, right? We've invested alongside a lot of other banks. And I think that is one of the things that makes us different from the average CVC, and that we hold ourselves to that those financial returns, that's what makes us very much like a regular VC at our stage. The next layer that really makes us different is, every fund brings certain resources to the table. Some funds will bring, corporate development help. Some funds will bring recruiting help. Some funds will bring their great network of lawyers or what have you. So, SC has something really different, and it starts with the really demanding line of business people, technologists inside the bank who have tested a product and said, look, this one passed muster. We've worked with the team, we've defined use cases that will serve us, and that's something that the average VC fund just cannot do. Post-investment, that means we're still there, able to define new use cases, able to serve as a reference point for new customers. We get to use our network of partner banks and clients as potential insights and customers for our portfolio. So I think that's another thing that makes us different. And then, the final thing is Lucy and her team, because when you're trying to go global, you need banking services that are right for a fintech company. And well, we're kind of global, and Lucy's kind of a badass. So.
All right. Lucy,
Thanks, Mike.
Great words coming to you bright and early your day. So I guess the next question is right at you. You obviously see lots and lots of fintechs as well as investors and globally, right? So what is your I guess experience been particularly this year with lots going on around us? Do you see any themes which are similar or different between the different stages of financing and also the different geographies in your mandate?
Yeah. So venture capital generally is somewhat scarce at the moment, I would say. Even more so capital that comes with real strategic value add in the way that SC Ventures tries to bring to the table, and a real sense of that collaboration and partnership. Last quarter was still down over 20% year on year. We have seen, though, a rise of mega rounds recently. In fact, the most we've seen since Ant Financial did its amazing $14 billion round back in early 2018. So what that shows us is investors are consolidating into larger late-stage platforms at the moment, and I do suspect that will continue largely into the first half of next year. But having said that, seed funding at the very earliest stages did in fact pick up in Q3 relative to earlier this year, perhaps given the profile of angel investors who are relatively insulated from this crisis and looking to deploy capital, whereas institutional early and mid-stage capital remains subdued, as funds have been focused, on shoring up their existing portfolios during this time. To mitigate that, we've been working closely with policymakers in Singapore, UK, and elsewhere to try to incentivize the earlier stage investment ecosystem. And in any case, I think it will rebound as the real economy starts to improve. Now, in terms of strategic M&A and investments, we're seeing a lot of big tech and larger fintech players who have the cash, the leverage capacity, and superior currency in the form of their stock driving deal activity. So they're on the hunt for new products, new customer segments, and new geographic markets. Bank capital can generally be harder to come by, but there are powerful opportunities in the areas where SC Ventures invests. In terms of fintech subsectors, payments still dominate funding, raising $4 billion in Q3, relative to, say, digital banking, which was at $2.4 billion, or insurtech at $1.2 billion. Geographically, I'd say funding trends are fairly similar across the US and Asia. In Europe, we're starting to see a slight pickup, and in Africa, a substantial pickup.
Thank you for that. Moving back to Anant, when you were raising capital across Series A and Series B, surely you met with a variety of venture capital firms and growth focused tech PE firms. What made it interesting for you to have SC Ventures as an investor on your cap table?
Yeah, it's an interesting story. So basically, when you go and raise money, the way it works is investors come to you and say like, hey, money is cheap. The value that we provide is, we will help you with customers. We'll help you with these like services and other things. Like everybody tries to basically sell you on the value that they provide. But Standard Chartered was different because they had already earned it. So you don't have to tell the value you provide because we were working with them for last 2 years. I mean, I talked about this in my previous answer, which is like Waving had sat with us in 50 different meetings to figure out which use cases to go after and how to basically navigate the whole organization. So it was pretty easy decision because I mean we owed it to SCB because they had already earned it. So that's number one. And number two, I think, is that sort of like, especially for us, in order to learn the kind of use cases, the kind of problem space that we wanted to get in, would only be possible if we work closely with someone, with a company that can provide us the fail-safe environment, which I talked about, a company where we can go and experiment, where things can fail and it doesn't affect the relationship or the reputation or the sort of like long-term prospect of working with them. And one of the things that with SCB we do is not just like providing value for the different business units and so on, but also do a ton of experiments where many of those things can lead to not the best outcome, can lead to failure, and we are totally okay doing it. So these were the two like primary regions, and not these primary regions based on hope, but something that we had already seen it, something that we had already experienced over the 18 to 20 months. So I think in short, I don't think it was a hard decision. You guys had already earned it. So
that's very comforting for us as a platform to hear, and very encouraging. And thank you for those words, Anant.
But also, I think that I think the word, the choice of words is interesting. I pick on the word earning, obviously, which you said several times, and I think putting yourself in the shoes of a founder, the elements prove to me, or this is a very valuable part of you, which you're agreeing to share, and in as much as you said we earn it, there has to be an element from an investor's perspective, banker's perspective. Yeah, we got to earn it. That's what we're here for, and hence the alignment.
Mike, now turning to you. Over the course of the year, our investment process was impacted, right? Number of challenges at our portfolio companies, just like what's going on in the world. What we typically do as a process, part of a typical investment process, the due diligence processes, etc. Can you walk us through a little more on your experience with this?
Yeah. So look, when we get a market downturn, and this wasn't the first one that we had, the first job of a VC is really to go look into the portfolio, and really what they're figuring out is which companies are they going to support and which companies are they going to have to abandon because they have limited resources and want to put their energy behind those companies that are most likely to generate a return. And we had to do that triage as well. But what was great about it is we sat around as an investment committee, and rather than talking about who are we going to give more money or not give more money, we talked about how can we help the companies we're working with find new revenue, which is always an exciting thing as far as an entrepreneur is concerned. And as a VC, I feel a lot better when I can have that conversation with portfolio companies. So I think that's pretty cool, and that reflects on just the general diligence process that I see you, Hari, and the rest of the investment team go through when the bank brings you a use case and a technology. You guys start digging into, well, what are the other use cases so we can of what the total lifetime value of a big enterprise is. And I think that's right. We have that internal point of reference, and then we get to go and talk to some of our peers in the industry, other banks, and see if they have the same problems and the same appetite for that kind of technology. So I think that's what makes our process, distinctive. Probably the other thing, which can be a bit of a turnoff to the average entrepreneur, but guess what? We're a bank, is we do have, a couple of compliance, and the lawyer's got to go do the due diligence, and the accountant's got to go do the due diligence in addition to our investment team. And sometimes that's a little bit longer, but when you're investing at our stage, it's kind of what you expect.
Absolutely. And Mike, just going back to you, when looking at some of the themes that we explored as a fund over the last, say, 12 months, the investments that we made, do you want to talk us through, say, perhaps a couple of our recent investments like STU and VArmor, and the themes that we are going after, or we were going after during the year?
Oh, God, you brought so many cool ones to the table. I'm not sure I can. I thought what was interesting pre-COVID was we were looking into some really future stuff, quantum computing and new compute architectures and these kinds of things. What was really interesting was as we hit COVID, we did a quick flip to those infrastructure technologies that would support sort of a permanent work from home world. So, enhanced network configuration, security, these kinds of things. So I thought that was really interesting. And now I guess we just announced today, that we did an investment in a company called OpenFin, which is a set of tools to help banks create a better user experience across all of their applications. And that's needed both for, general transformation of banks, but even more so when folks are going to be working from their home laptops connected to the VPN or what have you.
And I think it's just building on this, not so much the investments themselves, but again the themes. When any crisis hits, your first step is to survive, to fight another day. So there's an element of take a step back, go undercover a little bit and assess. And we've had to step in a little bit here and there, and to very much to our pride, the portfolio has done well, but that has kept us busy, so to say. The next reaction is, okay, the world's changed, and so what does it mean for future investment themes? So the fact, as Mike just alluded to, the fact that people are working from home, the fact that the e-commerce has skyrocketed and will plateau in a different position from what it was pre-pandemic. The fact that this has implications on infrastructure, this has implication on payments, this a whole bunch of different areas, and so new themes have indeed emerged, which were there before, but became were sort of accelerated by the crisis. So the few examples that Mike just mentioned are some of these. So network management is obviously important. Passwords and cybersecurity is obviously another big theme. And you just described OpenFin now. It's interesting how the pandemic has slowed down quite a few things, but also accelerated others.
Yeah.
Thank you, Mike. Thank you, Alex. Looking to you, Lucy. It's interesting, right? Fintech banking. It's something probably that did not exist as a standalone unit maybe 10 years ago. We've always covered clients in the technology space. We've covered clients in the FI space. But when you specifically address fintech as a client segment, what are some of the challenges that you see in banking technology companies, early stage technology companies in particular, and both from the typical banking products or bespoke fundraising or any of those processes that you help run? What are some of those challenges, which is, I guess, different from some of the other client segments, which Standard Chartered banks?
Yeah, it's a great question, and we're learning new challenges and trying to resolve them every day. So we work across our institutional product suite. So that's corporate finance, including M&A, capital raising, financing, financial markets, which for us is debt capital markets and a lot of FX work, and then transaction banking. where increasingly we're digitizing our own payments capabilities. And so we try to work across that product suite with our clients, especially in fintech, because our clients are operating in a lot of the same products that we are around payments, FX, lending. So inherently, the work that we do together is less like your traditional bank client relationship and more like a partnership. And so we're co-creating with them on digital products. And that inherently informs our more strategic dialogue with founders and with investors on M&A and investments and capital raising. Because we bring more of that strategic content from our own work as a principal and partner, which is great. In terms of challenges in the investment process this year, certainly in fintech, as in with the wider tech community, investors have been much more this year focusing on unit economics and path to profitability rather than growth at all costs. Particularly as during this crisis, the top line is challenged and can't support the high customer acquisition costs that fintechs were willing to invest in pre-COVID. We've also seen investors demanding much more clarity on entrepreneurs' core mission, asking what value do you really want to create in the post-COVID world, and what's your execution path to achieving that. So a lot of focus on streamlining product roadmaps, enhancing customer service so that you can increase your user engagement and retention, which hopefully will create upside post-pandemic. And in terms of the process, investing remotely without in-person diligence, that's more feasible at the late stages, which tends to be where we focus our banking franchise, than at the earlier stages, where investors, really want to look into the whites of someone's eyes because it's more important, it's more about the people at that stage.
No, absolutely. And one of the things that you mentioned, Lucy, that it's more of a partnership than a client relationship, and that's very interesting because that's something that Bill Winters picked up and emphasized on in his panel, the Singapore FinTech Fest opening session as well. So that was very interesting, a consistent theme that is sort of coming out of the Standard Chartered camp. I guess question to you, Anant, very specifically, it's one question that came up is. What has COVID done to your sales cycle and your implementation cycles, given most of your customers are large financial institutions?
Yeah, so I think what we have seen is more urgency to getting use cases implemented. And primarily the reason is now COVID, nobody can be in the branch. Humans can't do many of the things. So most of the things are digital. People are uploading loans digitally. People are applying for, every single operation that you can imagine is all happening by sending documents over email or over web. So we are seeing now, most of the customers recognizing that they have to get this done quickly, and they have to find a way where this is the new normal. This is the normal where you can't expect humans to be involved in every single operation. So we are basically seeing more urgency from almost every single customer towards the new world that they wanted to move in since last decade or so. At the same time, I think on the sales cycle, so there is definitely urgency in the implementation cycle. On the sales cycle, it's not I'm not trying to generalize this, but we have seen in some cases there are some budget freezes. So for example, hey, COVID happened in March and April. Now we are not going to buy new stuff because of the budget frozen, and let's move the procurement discussion to next year. And primarily the reason is because there is so much uncertainty in the market, and as a bank or an insurance company, we do not want to currently purchase, basically sort of go beyond the budget to take some extra money from somewhere. So we have seen in a couple of cases where the deal has been pushed to the next year. But in many cases, we have seen that there is more urgency towards getting this done quickly and closing the deals quickly. In overall, I have seen more urgency than deal getting pushed to the next year, but it's kind of 70-30. In 70% cases, more urgency, things getting done quicker. In 30% cases, things are getting pushed out to next year. So we have seen both.
All right. Okay. Thank you.
Which requires you to adjust very quickly, right? Because things that you thought were going to materialize may take a long time to materialize, and all of a sudden something pops up and you have to be all over it immediately. And so there's an element of being agile enough to react to these things.
Yeah, I'll give you the example of like Bank of America. I mean, so we had just closed a deal, like I think somewhere around April or something. And in general, with large enterprise customers, you take like 6 months to deploy the infrastructure, another 3 months to get the first use case in production. And then government launched Paychecks Protection Program for the COVID, and they just had no time. So literally, a company of that size was able to get everything, all the infrastructure set up within like a couple of weeks. And then that use case, the entire Paychecks Protection Program use case was built in 2 days. It took them like another couple of weeks to get them in production. And I don't know if you know, they were I think the highest volume Paychecks Protection Program processor in the entire United States, because they were the first one to go on Instabase and sort of like start processing those. So we have seen some of even the giant enterprises and complex enterprises move very, very quickly during this time.
Nothing speaks better than a happy customer. I'm sure they'll attest to that. So I guess we have about 10 minutes left, and I wanted to focus on the themes, right? What is in store for us in the next year and I guess the years to come. So perhaps starting with you, Mike, what are some of the key trends to watch out for in the next 12 months?
Well, I think we touched a little bit on this, right? I think there's going to be still a lot of emphasis on resiliency around work from home. I think there's going to be a lot of emphasis on making e-commerce more and more efficient for companies who traditionally were not in e-commerce. I'm seeing a lot of activity on the embedded banking side, where there's very early stage startups who are looking to integrate financial services for non-financial services companies. And one of my favorite themes, where is probably the second in terms of investment recovery after payments, is what I refer to as CFO tech, which is what is the stack of technologies that enterprises need to manage their finances, their payments, et cetera, more efficiently. So we're seeing a lot of that. And I guess I would say that, going a little bit back to one of Lucy's points, where I'm seeing investment, it's sort of very K-shaped. There's a lot of money pouring in to those companies that are top 5% performers in their segment at their stage, and they're getting oversized rounds, and I see that happen globally. And then everyone who's not in that top 5% is getting nothing. So the impetus to execute well is the trend for the next year for everybody.
Thank you, Mike. Alex, Lucy, do you want to chime in? Lucy, perhaps you first.
Thanks. Yeah, I'd say also definitely embedded finance. The West still has so much to learn from Asia in terms of integrating fintech into wider digital life and the real economy. The likes of Ant and WeChat Pay in China, Grab in Singapore, Paytm in India, they're really leading the way. In Europe, fintech is still far too siloed, so hopefully more upside there. In the US, certain platforms like Facebook, Amazon, and Stripe are starting to make great strides at this, introducing financial services within e-commerce platforms. And at Standard Chartered, in fintech banking, we're partnering closely with platforms on both sides of the hemisphere to help them deepen their market penetration in our markets where we're particularly strong, either by connecting them with investment targets or by connecting them via API with our own digital capabilities. And I think we'll see more of those embedded finance partnerships coming to fruition in 2021. Other trends for next year, government interventions, hopefully in real-time payment rails and digital assets as well, including with, the enabling infrastructure around digital identity. Payment platforms and banks both accelerating their data analytics capabilities to compete with or partner with big tech on insights and monetization. And then probably finally, I think there's a big opportunity for investment in automated, real-time and sophisticated financial crime compliance technology, within banking incumbents like us, but also within fintechs and other platforms, because regulation is still very varied and rapidly evolving across jurisdictions. So you need to retool solutions for different local contexts and productively engage with regulators. And to the extent that technology is still in development, I think investors are increasingly alive this year and next year to fintechs that have the skill set and culture for robust governance. And on the flip side, very alive investors are alive to markets with progressive and sophisticated regulators that are collaborative with market participants.
Yeah, that's a lot. So I'll start by echoing everything Mike and Lucy said, which makes me wonder or fear if we're in danger of falling into a bit of groupthink here. But obviously, we compare notes. So grateful if anyone in the audience has ideas or themes we aren't thinking about or not focusing on, or things we should be paying attention to. So feedback, input, always welcome. I just partly reiterate some of what you guys said by picking two broad generic themes. One's digital assets as part of the financial infrastructure of the future. The asset class digital assets is here to stay, but the infrastructure for it is still very, very nascent and immature. And so we're all going to have to build it. That is why we announced Zodia yesterday on the custody side, but more to come in that space for sure. And then the general one is perhaps an amalgamation of a lot of the things Lucy and also Mike said around identity, platform, business models, and the likes. It goes to the point of post-pandemic, financial institutions will be banking with a purpose, or they will not be around. So the societal impact that our businesses have is absolutely critical. That is what the world expects from us, in all the markets and the societies in which we operate. So themes like financial inclusion, things like supporting SMEs, things like banking people the way that they need to be served in order to be included in the financial system, are going to be of paramount importance. And the capabilities we just talked about, from ranging from a platform business models to financial crime compliance in a much more automated way than the way conventional institutions do it today, identity management and so forth, are essentially capabilities that will be enablers for that broader mission of financial inclusion and alleviating some of the pains that have occurred on the planet, and moving on from there.
Thank you, Alex. I think between the three of you, you've really painted a good picture here. So Anant, a question for you really quickly. In view of these trends that you see, right, and otherwise, how would you shape your strategy for Instabase for the next 12 months?
Yeah, so I think in addition to these trends, we also try to sort of look at by recognizing how our customers work and what we are hearing over the period. And this is how we have been thinking about this problem. So if you look at every single industry, the majority of sort of things that drive those are their operations, because you have to run lending, you have to run trade, you have to run different large operations within these enterprises. And if you go to if you look at last 10 years and today and the next 10 years, if you went 5 years ago and asked an ops team, what are your big problem? And they'll tell you our big problem is this database runs slow, or the big problem is that we need OCR because we have to process these scanned documents, and that's a problem. The reality is those were not really the problem. The reason why you say OCR or bad quality document is a problem because you have to process people's identity documents like passport that happen to come in the scan format or somebody's camera image. What if passport itself was a service or an app? What if pay stub itself was a service or an app? What if bank statement itself was a service or an app? Then you would not say OCR or classification or machine learning was the problem. If you go a layer above, you will find that it's not even that passport or the bank statement or the pay stub is a problem. The reason why you need to process passport is because you have to verify identity. What if identity itself was an application? The reason why you need bank statement or pay stub is because you have to verify income. What if income itself was an application, right? And you can go even a layer above. Why do you need to even verify identity and income? Because you run retail bank. Why retail bank itself is not an application? It's not that like, Standard Chartered retail bank in Singapore is different than DBS than somebody else's. They all pretty much do the same thing. They all have saving accounts, lending, checking accounts, and so on. And I think in future, the world where it will move towards is, I think the infrastructure, rather than thinking about IT and these sort of like, machine learning and OCR, it will more become sort of like the composition, which is you can buy identity, you can buy like, for example, like either you can buy identity app, or if you want to build your own, you can build identity app from identity documents such as passport or whatever. But all of those things will become the component that can be composed together to build higher level component, which can be building block for another higher level component, and so on. Like you can build your own bank by either buying a bank application or composing bank from things like income and identity and ledger and payment and so on. And I think an operating system of that kind will emerge, which allows you to basically think that way. That's where I think the world would move towards. This is my own sort of like very biased observation from what I've been seeing, but that's where I think the world would move from how people think about applications.
Thanks, Anant. My takeaway from that is Instabase is going to eat the world. So on that note, like I think we have literally 1 minute to go. So I want to invite any closing thoughts from all of you. This has been a great panel, and I want you to leave the audience with 2 words. 1 word that summarizes your experience in 2020, and 1 word to look forward to in 2021. What are those 2 words? They'll probably go in the order of Lucy, Mike, Anant, and Alex.
Okay, thanks. I'd say 2020 was intense, but for 2021, I'm hopeful.
All right. Mike, how about you?
Too many words, but what doesn't kill you makes you stronger.
All right. And what's for 2021? Is that the same for 2021?
Oh, yeah.
Oh, no. Anant, what about you?
I mean, 2020, we go through ups and downs. 2020 was not the best time, but that's how life is. It doesn't move always in straight path. Sometimes you have to take a step back to move forward. So the 2021 would be great.
All right. More promising than Mike. Alex, what are your closing thoughts and the 2 words?
Interesting. So obviously, I can't repeat what other people said, and I noticed that both Mike and Anand managed to break your rules of 1 word each, which we do all the time here. I think 2020 was a year of learning, lots of learnings, and it forced us to reflect in so many ways. 2021, I'm very tempted to repeat hope. But more, perhaps more importantly, this is a mission to improve the state of the world and solve the really big problems which we have on our hands, from financial inclusion to climate change to a bunch of other things. So make it better.
All right, that's inspiring. Thank you, Alex, Anant, Mike, and Lucy. This has been a great panel. I loved hosting this. And I'm sure the listeners have had a great time as well. This event, as I said, would be recorded. It is recorded, and it will be made available subsequent to this. So if there are any interesting comments coming through, we'll happily send them your way.
Somebody's asking what is the 1 word from Hari, by the way, on the chat.
Oh, all right. Well, my word would be crazy. It was a crazy bad year, and I'm hoping it'll be a crazy good year ahead.
Excellent.
Right.
Nice.
All right. Thanks, everyone. Have a great rest of the day.
Thanks so much. Thanks.
Take care, all. Thank you.